It was a mixed handover from Wall Street, and that is something which is reflecting in the Asian markets as well, largely.
For the Nifty Bank, supports come in at the 40-day exponential moving average, which is the closest level, 46,300. And then the 20-day moving average, which is 46,130 years.
They say BPCL offered the largest margin of safety. It was not only BPCL, they raised the target prices both for IOC and HPCL.
You've got the Nifty, which is starting at about 22,200.
But the long-term plan for us is to establish IKEA in all big cities and then expand in an omni-channel context.
Longer-term perspective, the demand growth forecast of 6% CAGR actually looks realistic.
So direct sources do share with CNBC-TV18 that it is likely to be an FPO.
The color suddenly turned deep red. We started the day absolutely fine.
For FY25, this annuity numbers are going to be in the range of 1,000 odd crores.
We are looking forward for the next year guidance around $10 to $15 million.
Nuvama, they've gone ahead, they've increased their target price a little bit. They're talking about a dividend payout of 40 rupees every year.
We've seen that sharp drop in the markets from the highs. In fact, that sell-off has intensified.
Good afternoon and thanks for joining us on Closing Bell. It is the last hour. We're coming to you from the CNBC-TV18 Motilal Oswal studios, and it's been a deep sea of red out there, not just large caps, mid caps, small caps. We're dealing with a red market. I'm Surabhi Upadhyay, with me, Nigel D'Souza and Mangla Malu. Guys, all red.
Red indeed. What a big decline that we've seen from the highs. In fact, the mid-cap end of things not looking good for the third day in a row. We have almost 2,000 stocks declining.
Well, indeed, for me, just on the headline index, just want to make a quick point out here. The 20-day MA, that's a line in the sand, both for the Nifty as well as the Nifty Bank. For the Nifty Bank, if you pull it up, you'll see intraday we breached that mark, but we have bounced off that mark. So, on the Nifty, yes, there it's, I think, closer around 100 points away from current levels. But just pull up the Nifty Bank as well as the 20-day MA. Yes, you'll see that. Intraday, we breached that mark. Now we're very, very close to that mark, but we're still a little above, so that's good. And on the Nifty Bank, well, the 50-day MA will become the important mark. That's on the upside. That's close to around 400 points away from current levels. On the Nifty, we have that market around 21,900 approximately. So keep an eye out on that. Crucial levels. For the time being, a bit of a pullback. I think as long as we hold above the 20-day MA, we're still pretty much okay. And there could be an expiry-related factor as well that's playing out today, guys.
It'll be very interesting to see, the expiry-related factor, especially in the last hour of today's trading session, because there is the absence of the Nifty Bank expiry. Tomorrow will we see the Nifty Bank and the Nifty expiry itself, because on the last week of the FNO series, we usually have, the convergence. Both the Nifty and the Nifty Bank expire on a Thursday, along with all the other stocks. So that'll be very important.
Just to keep things in context, this is not really a global fall in that sense, though if you look at the Hong Kong market, you'd wonder if this is a global issue. But no, because Hong Kong was its own story. They had the local budget there today, and there was a lot of talk about, boosting the property sector, etc. But this is a fall that's more India-specific, India-led. And I just want to talk about mid-caps. We've been telling you that it's the broader market which is, bearing the brunt of this sell-off that we're seeing. Now, here's something that's happened. AMFI, which is the Mutual Fund Association, it has written a letter to all the trustees, the mutual fund trustees. Now, what is AMFI saying? Essentially, it's saying that all mutual fund houses need to take more cognizance of the risks that are perhaps beginning to appear in the mid-cap and small-cap space specifically. That letter does use the word froth. So I just want to put that on the table. But it's not sort of asking for any drastic measures. It's just saying that mutual funds should have perhaps a committee in place that looks at measures to mitigate these risk factors. Remember, small caps and mid caps have been drawing a huge amount of money on a consistent basis. It's not large caps. Every month, month after month, it's the mid cap and small cap space which is drawing the bulk of the inflow that is coming in. So that's what they're talking about. They're saying that perhaps mutual funds can look at measures like curbing. Again, this is an advisory in nature. So maybe like curbing some flows into mid and small cap funds, could look at rebalancing. And then it also goes on to say that MFs must take some steps to protect investors against the first mover advantage when redemptions come in. Remember, when everybody's heading to the exit door, first one out basically gets saved. So they're saying, can there be some ways to tackle something like this? So again, nothing extremely alarming in the letter or in its contents, but it gives a sense about the sense of caution which perhaps prevails within the mutual fund fraternity when we're looking at mid caps and small caps. We'll get you more on this, more perspective, perhaps from the industry as well as we go along. But I think it's safe to say that it's been a big party out there, and mid caps and small caps is where the music has been the loudest. So, time to time you have a parent coming into the room, turning it down, saying, I'm watching carefully. So, all the kids kind of buckle down for a bit.
Yeah, so it'll be sounding like that school teacher, nah? Which is sounding, I think the cane is missing. But let's move on and let's get a technical call on the markets.
Let's do that. How should you position yourself in the last hour of trade? 22,000 is where the Nifty is right now. The midcaps bearing the brunt right now. As we speak, a lot of stocks are underperforming, but one of them which is actually uncharacteristically outperforming is Havells, up 5% in an otherwise wobbly market. Yesterday, Nimesh, did speak about Havells as part of his standout brokerage. There was a positive brokerage commentary coming in. The stock was up around 2.5%. For the second day running, we're seeing a 5% up move. And at a time when the markets are at the low point of trade, or at least in the mid-cap end of things, this stock is at the high point. So it will be very interesting to see where this one goes as well. But be that as it may, Mitesh Thakkar joins in with his closing strategies. Mitesh, a lot of volatility. In fact, just as we speak, the Nifty below that 22,000 mark.
So in fact, today the afternoon fall, in which kind of came, good part by the Bank Nifty fall, I think has kind of, shaken the hourly indicators on the negative side, and therefore I think I do suspect that there will be more declines. The first level in the Nifty is close to about 21,900, 920. But in case we see the Nifty break below that, then good chance that we are looking at 21,700, 650 zones to be tested, and I think that should be it. So it looks like a start of a mild correction. On the Bank Nifty, similarly, I think the Bank Nifty, as long as it's below 46,300, the short-term setup is negative, and 45,600, and then in a bad case scenario, 44,900 is the target on the downside. So we'll trade with some negative bias. I think long positions should be taken off the table, and people should look at exploring some shorting positions. I have a sell on Page Industries that's breaking down. So keep a stop at about 35,250. Look for targets of 33,800. And Ultratech Cement is the other one, which is also showing signs of correction. Here we'll take a tight stop loss at about levels of 99.20, and a target of around 9600 can be looked at.
Okay, all right, Mitesh, thank you very much for those trading strategies. We'll come back to you with some more ideas in a bit. But let's just dive a little deeper into the mid-cap fall. Like we've been telling you, pull up the advance decline ratio once again. Look at the advances, only 340 stocks. So Havells is one of the 340. But otherwise, it's a deep sea of red. Almost 2,000 stocks on the declining side of the market today. Manglam's been looking at the data. Manglam, tell us more.
Well, I'm looking at a bunch of stocks, and I've put them into three buckets and excluded the PSU pack largely because Hormaz is going to speak about that. That's a different beast altogether. But some of the stocks which have seen a big move over the last 12 months, and they've seen corrections from the highs as well. So we have Vodafone Idea, 150% over the last 12 months, and now it's down about 25%. And remember, a 25% fall from the top implies that you have to rally 33% from current levels just to make good your money if you bought it at a 52-week high. Birlasoft down 10%, MCX down 8%, Aurobindo Pharma down 12%. And these are stocks which have nearly doubled in the last 12 months itself. Now, if you look at some of the other stocks in this list as well, some of these rail stocks, for instance, Titagarh and Texmaco, both of them up 300 to 350% in the last 12 months. They've corrected around 20-25% from the top. Suzlon, another big mover, over 400%, has corrected about 15% from the top. BSE as well, after a 420% move in the last 12 months, has corrected about 10% from the highs as well. But apart from that, we've had a lot of big decliners from the highs in the form of Z, down 45% from the 52-week high. Navin Fluorine, almost half from the 52-week high. We have AU Small and Bandhan as well, which are down around 27 to 29% from the highs. So that's telling you the kind of weakness that we've seen in the markets, PVR, Inox as well. And these recent listings in the form of Idea Forge and IQ Lighting, both of them are down 40% from their 52-week highs. So one needs to be cautious here. Stocks that have seen a big rally have seen a bit of a decline from the top as well. But if you bought it at the top, then the rally from current levels will have to be a lot higher for you to make good those losses.
All right, Manglam, thanks for that. You come back to your seat. For the time being, we'll focus on some of those big winners which came in from the PSU basket. Horma joins us to tell us the list of those stocks that went boom, 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 and now they're seeing some bit of selling pressure. Hormas.
PSUs have been boom boom all along throughout 2023, and they started off 2024 on a similar note as well, looking at the traction that we saw in some of the railway names and all such kind of stocks. Even now, after the correction that we have seen, the PSU index, the Nifty PSE index, is still up 16% on a year-to-date basis. And the index, very recently, it was on the 16th of February when it made a peak of 9564, and from those levels it has corrected around 5%, and the drop in the index constituents has been a lot more compared to the index itself. If you look at the constituents, the top 5 losers there: HPCL, REC, Indian Oil, PFC, NMDC. Mind you, REC and PFC, both of them were the top gainers of the PSU index in 2023. Both of them had more than tripled through that year, and those stocks are down almost 10 or 11% from their peak. Even HPCL is down 11%, considering the rally that it has seen through the first 2 months of this year as well. And PFC and NMDC is the one that also had doubled over the last 12 months, and that stock is down 9% on a year-to-date basis. But there are certain names that are still bucking the trend even after the index made a peak on the 16th of February. Bharat Electronics is one of them. Since then, the stock is up 10%. Even then, it has rallied around 116% over a 12-month period. Hindustan Aeronautics is one that is up another 2.5%, and with gains of around 140% over the last 12 months. And Oil India as well. That stock is still in the green, while the rest of the other index constituents are trading in the red. But the PSU is a completely different basket altogether. You never know; you might just make up these losses in a day or two.
You never know, but yeah, for the time being, there is some red out there. By the way, on the large cap PSU screen, look at Power Grid. It's down about 4%, one of the weakest stocks on the Nifty. There's, of course, BPCL, SBI, NTPC, a lot of Coal India, a lot of large cap PSU stocks also feeling the heat today. Okay, on that note, let's move on and welcome our first guest on the show. We have Prakash Diwan joining in. Prakash, hi, afternoon. You know, typically in the last 1 month, every time we've had a day like today, this so-called correction, it lasts all of one session or 1.5 sessions, and then we go back to usual. Do you think it's similar? But, you know, that's the risk when you think that it's going to be like that every single time. What do you make of the events of the day?
Good afternoon, Sabir. So I think first and foremost, let's not get into a cry wolf scenario and lull ourselves into complacency. The profit booking that you see, while it may not be very dramatic, is something which seems like an aberration given the fact that we've, as you rightly said, we've bounced back from, these kind of bad days, rough days. But all of it put together, the Nifty is just down probably less than 1%. And when you have stocks losing 2 or 3%, there are some stocks which move up. So it kind of balances out into that 1% kind of a cut. In absolute numbers, 200 points on the Nifty might startle you, but as a percentage, it's really not much. And as Hormuz was explaining, there's so many stocks on the broader markets which have priced in, order book and a lot of the goodness in terms of the, trajectory going forward. And we are sitting on earnings expectations which are extremely vulnerable to corrections. So I think and we've just got over a result season, earnings season, where a lot of PSUs did disappoint, right? So it's going to take a while. It's going to take, growth takes time to come. It has to get digested. The balance sheet needs to kind of get, strengthened. Only then you will kind of be ready for the next move. So we are already pricing in a lot of those things. And that's exactly what the market is telling you, that let the froth be out. And it's in a way good because you also get some very good names. So let me just anecdotally give you an example. Now, Tata Motors, in spite of such a big run, probably is not even down 1% today. So there will be quality stocks. Look at the behavior that Reliance is doing. Look at the behavior that L&T is doing. So there are good quality businesses where the news flow seems to be quite positive. And that's what people need to look at. Don't get blinded by the red on the screen. There's always a pocket which is pale or green. And that's where you need to kind of fish.
All right. Hi, Prakash. Good afternoon. Good to see you in. Prakash, I wanted to ask you about Vedanta. A bit of a rarity. Market's under big pressure, but Vedanta is doing a thing of its own. Mr. Anil Agarwal and team, they have promised some very juicy things for this tree. They're talking about $7.5 billion of EBITDA for the group on the whole. They're also saying that the debt is going to come down at the parent level by $3 billion. So enough triggers out there. He's offering you a dance. Are you going to oblige?
So good afternoon, Nigel. So if you, storytelling is always part of the bull market, and there could be enough triggers, enough vectors that start changing the fortunes for this beleaguered company in India. But one good, setup, the tailwinds have been positive, the headwinds probably continue to be even more promising, and that's the commodity cycles. This company is sitting right in the middle of the promising commodity upcycle. And if that were to pan out even for the next 12 months, a lot of the debt burden that it shares will of course be kind of eased out. So I don't see any reason why they cannot do it. The timelines could probably be different because it takes much longer to set things right when you are already sitting on such a big leverage. But things seem to have eased out, and I can just tell you that the dark clouds that were hanging around in terms of repayment and all that, the repayments happened with one tranche with delays, but it has happened. So that probably gives conviction to people that even the subsequent ones will happen. So there could be some respite for this name, and that's precisely why there's bottom fishing happening. As a matter of disclosure, I do have exposure to this name. Of course, I like the dividend yield and all of that comes along with it. Apart from the pots and the moles with which you carry, but there is definitely a resurrection of hope in this name, given the fact that it's sitting in that midst of that cycle, that upcycle that I mentioned, and then it's not even over-owned. So that's one of the reasons why you don't see people hammering it down today.
All right, Nigel, you offered, you asked whether he'll accept the dance that Mr. Agarwal is giving him. He said, I'm dancing already. I'm on the dance floor.
He's part of it.
He's part of it. But Prakash, I wanted your thoughts on Havells. We've been talking about how it's been outperforming for the last couple of trading sessions. Is this the wire that you have caught hoping for some fire?
No. So they are, a lot of these guys are, they are into these anti-flame retardant technology, and also there's no fire in this wire, hopefully. But I haven't got any exposure to this, but I believe what's happening is that a big part of Havells' story was, the slow moving Lloyd's piece, and that's where probably, things could start looking up, that we are sitting in a cycle, at a juncture where the demand cycle will start looking up because the summer is around the corner. Secondly, the UCP business is seen a huge advantage in cost reduction. And this whole transition from dependence on China to a lot of the indigenously made components, I've seen it happen in a lot of the segments, including air conditioning, including coolers, including ovens and chimneys, and all of these, allied fields. So there's lots that happening. And if you go by what Mr. Tyagi yesterday mentioned about the kind of demand that's there for premium housing, I don't see any reason why air conditioners will not reach a market size of about 4 crores in the next 3-4 years. And that's a huge market build-up from where we are. We are roughly about 1 crore a year, and then that is where it could move. So there's significant amount of upside for them. They just need to make sure that they don't do self-goals, commit to self-goals going forward. But it's a good stock. It's a good business, good franchise. It could do well. And after what's happened to Polycab, you've seen there is very clear understanding that this is a business that generates a lot of cash. And if you were to kind of, utilize that cash well, whether it's Havells or KEI or Polycab, all of them are sitting in the same, fertile kind of a ground to do well. So there will be a connection, which will be positive, but you need to kind of have a slightly longish horizon to start riding it from here.
Okay, fair enough. Yeah, quite a move. Last 2 sessions on Havells. Prakash Seon, we'll have more questions for you in just a bit, but right now we do have to take our first break on the show. Back with more in just the next couple of minutes. We'll, of course, also get your perspective on the whole mutual fund issue with respect to Midcaps and whether there's any linkage in the sell-off today with the Amphi letter that's doing the rounds. Welcome back. Joining us now is a special guest to talk about how the mutual fund world is looking at all the money that's slushing into mid-cap and small-cap funds and whether there's any reason to be concerned. Remember, today is, of course, all about this mid-cap fall that we're tracking. Mr. D.P. Singh, who's the Deputy MD as well as the Joint CEO at SBI Mutual Fund, is with us, the largest asset managers of the country. Mr. Singh, thank you so much. Good afternoon, sir. It's great that you could take out a few minutes for this call. So want to understand that apparently AMFI, the industry body, has written to all the members, all the mutual fund trustees, saying that some kind of systems should be put in place to protect investors from any crack or any risk in mid-caps and small caps. Can you tell us exactly what this is about and what measures might come forward?
Yeah, certainly actually I would say a step in right direction, because regulators were worried on one part that a lot of money is flowing into this sector and the number of stocks are limited. And number two, when a lot of money is flowing and getting into those stocks only, the stock prices go artificially high. So that was the reason they wanted to have a look at it, so that there is no big gap in demand and supply. So looking at that, they are just trying to discipline this thing, because unfortunately, in spite of all the education, people still put money looking at the past returns and thinking that the future also will be the same. And while putting the money in a particular stock, they may not feel like that. So regulator being the response,
But sir, just one clarification. First of all, has anything directly come from SEBI? I mean, we're not aware of that, because this AMFI note seems more of an advisory, sort of a self-regulatory advisory nature.
It is advisory only, but regulators are always, AMFI as a body keeps on interacting with the regulator also regularly. When I'm not saying it's come from SEBI, but when the serious discussions happen, these are the points which are being discussed. I'm not saying this is dictated from SEBI or something like this, but when we interact, when we discuss, so these are the points which are being discussed, because ultimately all of us want that the investor interests should be protected. So keeping a discipline on that, the mutual funds are creating some discipline, and this is just a reiteration of that.
You know, Mr. Singh, reading from the contents of that letter, it says that mutual funds should put investor protection policy in place with regards to small and mid caps. That is point well taken. But then there are three important points thereafter as well. One, moderating inflows into small and mid cap funds. Secondly, look at portfolio rebalancing to limit risk. And third, must take steps to protect against first mover advantage in case of redemptions. Is there any action in the very near future which is likely on all these things? And what do these steps entail?
No, first two actions are actually happening already. If you if I talk about small cap fund, in case of our fund house, SBI Mutual Fund, we were aware about this and we stopped getting lump sum inflows from 2017. For 7 years ago, we are not getting any lump sum money. We are getting money only as SIPs, that too limiting up to 25,000 rupees. Yesterday, I saw another fund house also has done the same thing. They have limited up to 25,000 rupees SIP and 2 lakh rupees of lump sum money. And I'm aware some other fund houses also did it. Because one, there's a lack of ideation. The money which is flowing in is outpacing the stocks, and at the right valuation, and the good businesses evaluation were limited. So this is just to give a caution note to everybody that this is something which needs to be done. As far as third point is concerned, I am not aware about anything happening at that level. And I think this is the first step which has happened, and over the time, a lot more discussions will happen at the AMFI level, and then we'll see if something can be done.
All right. Hi, Mr. Singh. Good to see you. Well, within high-risk categories, how can fund managers create some kind of safety net, sir?
So see, in any risk category, there are high risk and low risk. If you talk about small cap also, there are more riskier small caps and there are safe small caps, right? The businesses, the level of businesses, the growth trajectory, so on and so forth. There are so many parameters which fund managers look into it. So within that definition of risky, there are safe and less risky kind of thing. And then the number of stocks which are being researched. There are so many parameters which can be looked into.
Sir, so, at your end, are there any specific measures that you're thinking of at this point in time with respect to the mid-cap and small-cap strategies that you're running?
No, the only message is this: yes, Indian markets are doing well. India is in a very, very sweet spot. But past returns should not be seen, never be seen as some giving some suggestion that the future is going to be the same. Because the last 1 or 2 year returns have been fabulous. It's an effort towards toning down the expectations of the investors.
No, I meant, sir, in terms of any fresh curbs, in terms of the flows that these funds are drawing in, or any other restrictions that you might look at. Just in terms of fund management as well, managing that mid-cap and small-cap corpus, any fresh directions you may be giving to fund managers?
Every fund house will look at their own position. This is an advisory, and when they look at it, the surplus is, the inflows are much more. Like, for example, we are having almost 600, 700 crores of inflows coming through SIP route. And the similar is maybe 100 crores here or there are the outflows. So we are managing it very well. So we don't have to worry about it. But somebody else who is getting much more money coming in looking at the past returns, they will definitely have to think about it, how to put some curbs in their fund house.
Okay, all right. Mr. Singh, I think SBI Small Cap only takes SIPs, right? No lump sums. Do you think the other mutual funds as well will? Yes, sir?
No, everybody will have their own policy, right?
Right, but do you expect others as well, sir, to follow? Do you expect others to follow suit as well? As you said, y'all are not taking any lump
I told you yesterday, one of the credible fund houses, they have already announced that we will be accepting 2 lakh rupees of lump sum and 25,000 rupees SIPs. And I think this is a trend which will come in some other fund houses also. But sometimes what happens when you put the curbs, the people feel that curbs are coming, let me put more money. I like to caution that. Please don't get into that. This is a very serious and very, very serious message. Take it in the totality. Don't rush for putting more money because the curbs are coming.
Right.
That may put you in trouble.
Just one question from my end, Mr. Singh. The AMFI, of course, did a great job in telling people mutual funds sahi hai, so much so that more people are rushing towards mutual fund than the ideas and the valuations can support, especially in the small and the mid-cap end of things. But is there any likely change in the amount of cash that mutual funds can hold before deploying it into the market so that, it at least creates a bit of a cushion and not compel a lot of these funds to go ahead and buy more of the same stocks that they have?
See, what happens, every fund house has their own investment policy, and as per this, generally 8, 10%, 15%, some people can keep, some people are giving 5%. But nobody will keep 60, 70% as cash. You have to avoid it because the mandate from the investors is to put into equities. Because
how much are you keeping?
Sorry?
At your fund levels, how much cash are you all sitting on right now, and how does that compare with the average cash?
No, I will not know the exact numbers, but generally we don't go beyond 10%, generally never. Because the mandate from the investor is that to be in equities, because equities are uncertain, we can't go beyond the mandate which is given by the investor. So every fund has their own policy, other than the regulatory curbs which are there. But that's how it is. But I can assure you, the whole mutual fund industry, people are working in a very, very responsible manner. MP has come out with this suggestion just to say that yes, we are here to take care of your interest, and we want to give a cautionary note also that don't be in a hurry to put in money in lump sum in these small cap stocks.
Sure. Absolutely, sir. Your message is well taken. And I think we're seeing, routine profit booking as well set in, and maybe that's just great. It's probably for the best. Thank you for joining in with that perspective on how AMFI is looking at the mid-cap and small-cap arena, considering the surging inflows that we're getting there. Well, from someone who's running a big fund house to a stock picker, we have Rupesh Patel, Senior Fund Manager, Equity Investments at Nippon India Mutual Fund. Rupesh, good to have you in. I mean, before we get down to the usual brass tacks questions, let's just weigh in on this. This whole mid-cap fall that's happening, I think if you could hear Mr. DP Singh of SBI Mutual Fund talking about how different asset managers are looking at putting curbs in place, checks and balances in place, so that there is no overheating. For your mid-cap and small-cap fund, what is the stance right now? I mean, how are you managing the inflows, given that perhaps valuations have really run up in this whole universe?
So thank you so much, Surabhi, for having me on your show. Now, as far as risk management is concerned, I think it's an integral part of portfolio management. So we at Nippon have well-defined processes wherein, for each and every fund, we look at various risk parameters, which includes what kind of liquidity we have in our portfolios. And that's something which is monitored on a very regular basis and is presented at and discussed at our investment committee levels as well. As far as flows are concerned, you are well aware that we have also on our small cap fund some time back only have stopped taking lump sum investments and are allowing only investments through SIP route. So, wherever we felt that we need to take steps to protect interest of our investors, we have taken those steps. And as far as risk management is concerned, as I said, it's something which is an ongoing thing which goes hand in hand with the investing actually.
Vish, how are you feeling about the market right now? Everyone's talking about this overheated nature of small and mid caps, and in light of the constant money that is coming to you every month, how are you looking at asset allocation? Are you looking for newer ideas or putting more of the same in your existing ideas? If I had to ask you, the proportion of money that comes in, that goes into new companies or new asset ideas versus the ones that go into existing ones?
I think it's combination of both. When we are managing money, we are constantly evaluating the opportunities which are there in the market versus what we have in our portfolio. And we look at these opportunities from risk reward perspective. We look at these opportunities from future growth perspective. We look at these opportunities from liquidity perspective. And wherever, weight adjustments are required or inclusion or exclusion of certain securities are required, when that goes on, I think it's a continuous process and would be very difficult to, very categorically divide it into what percentage goes into new ideas and what percentage goes within existing stocks. So I think it's a function of risk reward and future growth opportunities which these companies present.
Yeah, theoretically, I get your answer, but what is it that you've recently done, if you could tell us? So where is it that you've reduced weights? Where is it that you're looking to increase weights?
Yeah. So the way we approach, actually, we evaluate, yes, in any bull market, there would be pockets of euphoria. In current market also, particularly on relatively smaller cap names, there is euphoria. Some of the sectors which have done pretty well in maybe last 2-3 months, you can very well figure out that some of the stocks have gone up to where, they are bereft of fundamentals. There is a lot which is going up on narratives. So I think as a prudent money manager, it's our job to avoid those narratives, to limit our exposures wherever valuations are extreme, to make sure that the stocks which come in the portfolio are backed by fundamentals. There can be near-term challenges on some of the names because of growth being weak or valuations appearing higher in near term, but maybe from medium to longer term, they still present an interesting opportunity. And that's what we really try to do in our portfolio construction.
Okay. So Rupesh, let me put it the other way around. On days like today, these are great opportunity days to go in and buy more mid caps, or are you looking to sort of lighten some positions now? And what's the cash level that overall, you're running across most of the key funds?
So as a fund house, we don't believe in taking large cash calls trying to predict which way markets will go. So the cash which is there in the funds is more to manage liquidity and take advantage of, some good opportunity which comes your way on a day like this, or maybe when some large block deals happen. But otherwise, we believe that the mandate given by investors is to invest that money prudently in the markets. So we don't really, try to take large cash calls and trying to predict which way markets will go. So accordingly, we will have maybe 3 to 5% cash across our funds. In some cases, maybe even less than that. But definitely no large cash calls in the market, in the portfolios.
Okay. Finally, just leave us with then the top overweight sectors for you at this point in time. Markets may do their own thing, but just in terms of the house call, which are the biggest overweights and why?
Yeah, we believe that in the current context, some of the relatively larger size companies, say larger banks, they offer better risk reward because, I mean, if we see then, I mean, as far as asset quality is concerned, that continues to remain benign. Last quarter, we have seen some pressure on margins, but I think this is something which is very well flagged off that deposit mobilization is not keeping pace with the credit growth. But since it's well flagged off, market is well aware of no likely surprises on credit quality, at least in near term, and valuations are reasonable. So that is one space where we are overweight and we have a meaningful exposure across most of our portfolios.
All right, Rupesh, thank you so much for joining in and giving us your views on the markets, the themes that you like, and the way one should approach markets in the current situation. What we'll do is we'll actually take a short break, come back, talk more about the markets with the news that the Nifty is actually down about 200 points right now, meandering between 22,000 and just below that. The Nifty bank continues to languish with a 500-point cut, and the midcaps, they haven't gotten any better. 1,900 stocks still declining with 345 stocks, which are on the advancing side. Come back, we'll tell you what the dealing rooms are making of in the market in the move today as well, and about the stocks as well. That's the Street Chatter. We'll also get you buy today and sell tomorrow calls from our technical expert.
Welcome back. Well, I think Bajaj Auto is the stock that's coming off a little bit from its lows. Tomorrow's a record day with regard to that buyback. From an institutional perspective, you know, the buyback ratio will hardly be a couple of percentage points, but from a retail perspective, it could be around 15%. That's the rough estimate in terms of buyback. So today's the last date. If you wanted to participate in the buyback, tomorrow's a record day, so today's the last day to buy. So I guess that stock is making a bit of a move on that front. On the flip side, those stocks that are taking it on the chin, UPL, you know, that stock has moved to the low point of the day, so pull that one up. And Shriram Finance, the street is split in its verdict, whether or not it's going to get included or not. Till yesterday, everyone was on one side saying Shriram Finance is coming in. For the time being, in fact, it appears as a split verdict, and the stock is nervous as well. From the high point of the day, it's corrected close to around 3%. So interesting outcome. We'll know that in the next 3 to 4 hours. But for the time being, let's have a question to Nimesh. He's standing by to tell us what is he picking up in terms of D-Street Chatter. Nimesh, a session where the bears will be feeling good, the bulls are getting nervous.
Oh yeah, absolutely. In fact, we're closing towards the expiry, a bit of nervousness as well, especially in the broader market. So the breadth has been quite weak in today's trade. The flows, again, it's not been very aggressively on the sell side, but the last many days I've been saying this, that there is no big buying coming in. Even if you look at the institutional data for the last many days, it gets colored because of the large block deals. So if you exclude those, then at the margin, the FIs are not very aggressive buyers for that matter. So that's clearly the view. In fact, the other segment which is seeing a bit of profit booking is the PSUs. That's been the momentum boys, and now you're seeing clearly that's where the big profit booking seems to be. Even in today's trade, the OMCs are down another 4-5% after correcting 10% from the highs. So clearly there is profit booking now visible across the PSU basket, whether it's from retail investors or from the HNI investors as well. Again, there are a couple of liquidity events to track after the expiry tomorrow. So watch out for the MSCI and the FTSE rebalancing. That will have an impact. And of course, the index rebalancing will get announced today. So that will have an impact on some individual names. You referred to the likes of Shriram Finance. So that is something to track. But frankly, the feedback is some bit of profit booking is clearly visible in the broader markets and the PSUs. But the flows are not very negative. Is the overall feedback as far as the flows are concerned.
Right, and individual stocks, Nimesh, what's the chatter around them?
Well, bit of correction in the broader markets today. So a lot of stocks are from that space. The first stock is Varun Beverages. Big sell-off in that stock, down 4% and large volumes as well. And I understand there is aggressive selling from the larger FIs in Varun Beverages. The problem in Varun Beverages is, Mangalam, it's heavily institutional owned within the FIs, and there is very less mutual fund participation. So any sharp sell-off from a larger FIs have a big impact on the stock price. So that's playing out in today's trade in Varun Beverages. The second stock is Max Financial, been one of the big outperformer in today's weak market, largely on back of strong buy flows, and also there was Jeffrey's note where they said things could be very strong going forward for Max Financial, and that's buzzing in trade today. The third name is Kirloskar Oil. This is standing out purely because after a long time, some bit of institutional interest seems to be back. But the stock is flat to marginal negative, but there is buying interest from larger institutions in Kirloskar Oil at these levels. And the last one is Juniper Hotels. Today's listing locked at upper circuit after listing. And I understand a leading domestic mutual fund has bought post the listing in today's trade. So the disclosures could be important there, but rank outperformer in a weak market again in today's trade.
Oh yeah, that listing's gone down really well, and it's been quite steady for Juniper Hotel so far. Thank you very much for all the action there, Nimesh. Well, with that, let's go back to Mitesh and see if there are any other trading ideas one can work with. There's a little bit of an added pressure on the Nifty since the last time we spoke with Mitesh. Remember, the 20 DMA is around 21,934. And this is a bit of a second leg down that we're seeing. So let's see if that holds or not. But Mitesh, what's the advice now for the final few minutes?
I did talk about test of 21,900, 920. I think that's looking like it should happen right now, maybe tomorrow early morning. But yeah, the structure has changed slightly on the weakest side. So we have two STBT calls. Kotak Bank is something, which is trading near the swing lows. So that's STBT with a stop at about 1697 for targets of 1660. And GNFC, a similar chart, I think, it's also getting into corrective mode on the hourly charts. So STBT here with a stop at 656 for targets of 640.
All right, so those are a couple of stocks that Mitesh has for a reverse trade tomorrow. Mitesh, we'll come back to you. Meanwhile, just keep an eye out on Juniper Hotels. So Juniper Hotels has done well, has had a good listing in an otherwise wobbly market. What is it that the street liked about them? Before they came out, before the listing happened, the street was worried about the debt on their books and the lack of any scarcity premium, largely because there are already a lot of hotels. So what is it that this one has on offer? And that reflects in the kind of subscription that we saw as well, just 1.19 times subscribed. Listed also subdued with just a 1% move. Thereafter, the street started buying into what the company will do post-listing. Now, here's the thing. They have a debt of close around 2,200 crores on the books, and they will use 1,500 crores to repay that debt in as soon as the next 2 to 3 days itself. So that takes away most of your finance costs. Over and above that, they are looking to expand their portfolio to invest about 1,200 crores going forward. Then the worry was, how are they funding this 1,200 crores? They said that the finance cost that they will save from this will give them positive operational cash flow. And over and above that, they won't increase their debt beyond 2 times EBITDA in any case. So that gave some comfort. This year, they're targeting revenues of almost 800 crores. Next year, they're looking at an EBITDA of 500 crores. And importantly, their current room portfolio has close to around 1,800 rooms. They believe that they can scale this up by another 1,000 rooms in the next 2 years itself. So balance sheet correcting in a sector which has some tailwinds alongside some expansion and a promise of the management by keeping their balance sheet intact has the street excited, and that explains why the stock is higher.
Okay. In fact, I know you folks caught up with the management as well of Juniper Hotels. So let's just listen out what kind of growth projections and the opportunity ahead that they told us about.
Out of the 1,800 crores, 1,500 has been earmarked for deleveraging, and we will be deleveraging that within next couple of days. This year, we will be closing the year. The first year, that is 24, will be our historical year, and we will, in 25, we will have a surplus of almost 500 crores coming into the company as part of the EBITDA. Our real trajectory at this moment is going to be that we are going to keep our debt level below 2 multiples of EBITDA. We will use the money to leverage, to acquire new assets and grow the company. So in the combined effort, we will be investing more than 1,200 crore rupees going forward in next 2 years is our plan. We are open to hire any international or domestic brand which is going to fit into our assets. Going forward, we are intending to add 1,000 more keys over the next 2 years into our portfolio of assets.
Okay, all right, that's a new kid on the block, doing pretty well in today's trading session. Alchem Laboratories has the stock in focus, and EIR, that's the Establishment Inspection Report, has been issued for one of their facilities. I think it was the Mandwa facility. So, let's pull up the stock, let's see what it's doing. As of now, it's more or less flattish as we speak. But Mayuresh Joshi joins us on the show before we end. Mayuresh, it's that sort of a day, right? If you're asking for a dip, your wish is granted, you've got that. If you're looking to buy something, what would it be on this sort of a day? Because plenty of stocks are down with sharp cuts.
Afternoon, Nigel. At Markets with India, obviously, we are looking out for stock sectors where the earnings momentum is expected to continue at a very good pace in the next few quarters. And that probably gets reflected in our EPS ratings and rankings. And with that, I think if there is sufficient amount of institution strength backing it up, that gets reflected in price as well, which probably remains very, very resilient, even in market falls or substantial market falls like we've seen today. Having said that, I think a couple of themes that we are probably looking at within the broader markets. One obviously still remains within the auto ancillary pack, the battery players. So Exide, Amara Raja still seem to be very, very attractive at this juncture. Both these companies have embarked upon an capex in terms of creating sufficient capacities for lithium-ion batteries over the next few years. And a large part of this capex is going to come in from internal accruals. So there is not going to be sufficient amount of leverage that gets built in, even as these capacities come on stream. The second element, obviously, with internal combustion engines still expected to do well in this entire transition phase that we'll probably see over the next few quarters, as a lot more EV products starts getting rolled out from various OEMs. They should be sufficiently equipped, even on that part, over the next few quarters to service both the OEMs as well as the replacement market. Again, both these players have a large part of the industrial business as well, which acts as a very good support in times where auto volumes can probably remain on the sidelines or probably consolidate, which they might at some point of time as we head into the next few quarters. Input costs have largely stabilized, which means margin should be relatively better as well. So I think this story probably looks far more structural in our opinion, and both the EPS RS rankings looks fine. The other stock that we have just recently looked at, and as a clear disclaimer, we have added that in terms of our model portfolio and suggested that to our clients as well, is Poly Medicure. Now the company, interestingly, post his numbers, has given a very interesting commentary, Nigel. They're expecting revenue growth to grow in excess of 22 to 24% at the higher end of the band over the next few quarters. They had started off the year with a 20% growth. So that's a very strong positive as far as the revenue numbers are concerned. On the margin front, they're very, very hopeful of maintaining that margin band between 26 and 27%. The industries that they cater to, specifically the hospital equipment space, and the kind of products that can come through, looking at their commentary, specifically the US market, they're expecting 8 to 10 products over the next few quarters, which can be high margin products, which will be extremely value accretive to the bottom line as we speak. As these get monetized and obviously distributed and circulated within the US markets, should contribute significantly well. The Italian subsidiary is doing reasonably well. And again, a large part of the expectations in terms of input costs being stabilized in the domestic business, specifically the renal business, expected to come back to strong growth, would mean overall numbers would probably look positive. So I think a few of these diagnostic players, hospital ancillaries, and auto ancillaries, they probably look attractive at this stage.
Take that point, Mayuresh. Thanks a lot for that. Yes, the management has joined us here multiple times. The growth in their critical cardiac business as well as the renal business is something that we will be keeping an eye out on. Take a short break, come back. On the other side, we'll focus on the markets and the market closing itself. Stay with us.
Well, welcome back. Just a couple of stocks actually, particularly from 3 p.m. onwards, have started selling off. One is Delta Corp. I don't know whether the street is sensing something on this one because it's moved to the low point of the day. It's down close to around 5.5%. And you have Metropolis Health that was actually trading in the green till around 3 p.m. odd, and that stock as well has seen a bit of a rounding. Mangalam, you want to comment?
Delta Corp, Nigel, it is also the last 1.5 sessions for the stock to be in F&O itself. Come February series, the stock is out of F&O itself. So a lot of those pending positions which are there may perhaps be are being unwound right now. And most of this series and the previous series, the stock was in F&O ban itself. So maybe some unwinding is underway in Delta Corp at a time when the stock will cease to trade in F&O from the March series itself.
Absolutely. By the way, one more stock, Vodafone Idea. Look at the market's thumping reaction to this big announcement about 20,000 crores of equity. The market saying we'll believe it when we see it in terms of actual money, actual investors, because the stock hasn't recovered at all. And this is after going into the event on a bit of a weak notice.
And on Vodafone again, the technical factor is that there is so much open interest build up that the stock may once again go into F&O ban today. So that's, 1 day ahead of expiry, which explains the further pressure that we're seeing. So let's see how that pans out.
Absolutely. Mayuresh, comment on this. I mean, on telecom, we had favorable news on Bharti, which kind of gave some green to that stock today. Vodafone Idea, anyone's guess what's happening next. What are your bets in telecom like? Would you buy anything afresh? Would you buy, for instance, Bharti now?
Afternoon, Surabhi. We'll wait for a pullback. And obviously, I think if you look at the positioning between all the three names, Jio through Reliance, Bharti Airtel, obviously on its standalone and console numbers, and Vodafone Idea as well. Obviously, the market share gains, both in terms of subscriber market share and revenue market share that Bharti and Reliance Jio are gaining at the behest of Vodafone Idea, has been very, very prominent over the last few quarters. The kind of capex that Bharti Airtel has done, specifically in terms of its 5G outlay, infrastructure, optical fibers, have been very, very aggressive over the last few quarters. And as they fructify in the next few months and quarters as well, I think a substantial portion of the 5G revenue will start accruing. The trigger, Surabhi, for both these stocks, whether it's Bharti or Jio or even Vodafone Idea, is at what point of time will the ARPU increase come through? Because the street is sensing that it is high time that ARPU increases come through, both for the 4G and the 5G ecosystem, as well as for the enterprise plans. And if that happens over the next few weeks or months, it creates a sufficient cushion in terms of significant cash flow improvement, deleveraging the balance sheet, and therefore creating a better return profile as well. So definitely wait out for pullbacks on Bharti Airtel. Jio through Reliance obviously looks very, very attractive as well. So yeah, I think both these stories on pullbacks can look decent.
Okay, all right. Well, the stock of the last few minutes is going to be Shriram Finance. In the next few minutes, we'll know whether or not, in the next couple of hours, we'll know whether it comes in the Nifty or not. But that aside, Mayuresh, what's your view? If there is a disappointment and it doesn't come into the Nifty, valuation support it has, but maybe some on the street were playing for this event. Would you be a buyer or are there better opportunities?
So Nigel, yes, I think there is always a different but if that does correct because of this reason, and if it does pull back, I think it would present itself to be a good opportunity for investors who are long-term looking at a structural story. As a clear disclaimer, we do own this stock in our portfolios. And our take is very clear. The kind of franchise that Shriram Finance has, the expectations in terms of very solid advances growth, even in lieu of the RBI circular for the unsecured stroke personal loan advances, Shriram has a very minuscule portion of that, hardly 2.5 or 3%, which de-risks itself in terms of any additional provisioning that might be required even on this book or any potential defaults thereof as well. So I think it's a solid franchise in our opinion. If it doesn't get added in, maybe that disappointment might come through, but it might last only for a few days. We continue to be holding this stock and continue to remain optimistic on this.
It might last only for a few days. The other contenders would perhaps be the likes of Zomato, etc. If that were to happen, then what will be very interesting would be the PE of the Nifty itself, because the last few additions on the Nifty, a lot of them have been from the FMCG pack itself, most of them trading upwards of 40, 50 PE, and that structurally has taken the Nifty's own valuations higher as well. But finally, before we let you go, Mayuresh, your thoughts on the hotel space? We were talking about Juniper Hotels, and everyone's pretty gung-ho about the tailwinds in the sector right now. Would you look at Juniper or still stick with the leader?
Juniper is a new listing, so I think let's see how the numbers play out. And obviously, as you pointed out, with the debt deleveraging happening on the balance sheet, a substantial portion of their finance cost is going to come off the balance sheet in the next few quarters, implying that the earnings should see a strong bump up with lesser interest costs that are happening there. Obviously, I think the entire sector probably looks very well placed over the last few quarters. And even as we speak, weekends probably are still full, occupancy rates still expected to be significantly higher. We'll obviously jump into the hottest holiday season as we enter into Q4, the end of Q4 and the beginning of Q1 as well. But a lot of these stocks, Mangalam, have moved up quite significantly. They trade in far higher levels above pivot as we see it at Markets with India. But I think stocks like Indian Hotels, stocks like EIH, stocks like a Lemon Tree, if anybody is holding, they can clearly ride to the momentum, but have your risk practices in place. Any 1 or 2 quarters where I think the numbers don't match expectations, the sell-off can be equally brutal as well.
Yeah, absolutely. But I don't think we have an off-season in terms of tourism in India anymore. Barring exam season, everything else is tourism season, I think,
it's
in the country.
It's not optional.
It is. But the
it's
thing
not
is that,
seasonal.
the
Mandatory.
thing is that exam season is a is off season for people who have kids, who have exams, etc. That's actually great season for people who don't want kids around there.
So basically, it's 365 days a year. It's travel season in India, the way we see it. But Mayuresh, thank you very much for joining in. Good having your insights on all that we've discussed today. By the way, this market is ending with a crunching blow. Very rarely do we, end literally the last tick is going to be the lowest, level of the day, and that's how we're ending out. Look at it. The Nifty is now tracking a cut of about 273 points as we're heading into the last few seconds. The fall on the mid-cap index is in excess of 1,000 points. The Bank Nifty is down 1.5%. It's been a sort of weak day. No two ways about it, no other way of putting it. Okay, so let's quickly tell you where the blow came in from with respect to the large caps. Some of the weakest names include Power Grid, Apollo Hospitals, a lot of the auto stocks, Bajaj, iShares, all weak. There was BPCL, OMCs have been cooling off in the last couple of sessions. But really, I could just go on because barring two or three names on the Nifty, HUL and